setup.
The lighting's very good
The
on your eyes,
lighting,
Stu.
yeah.
I'm Beverley Morris, Head of Liquid Markets Group at QIC.
I'm Stuart Simmons, Head of Multi-Asset Solutions.
And this is From All Angles. All right, let's do it. The question
Absolutely.
here, Stu. How can derivatives help investors to navigate a world where it is increasingly challenging to decipher noise from signals? That's a big question.
It's a lot to unpack.
There is a lot to unpack. I mean, you and I have both been around markets for a while. Does seem like an awful lot of noise at the moment, though.
It does seem like an awful lot of noise at the moment. A lot of uncertainty, some peak valuations out there in risk assets, and also doubts around the efficacy of some of those traditional diversifiers like fixed income.
Yeah, no, you're not wrong. And I think even traditionally it's hard to unpack some of those underlying signals, but you've got really offsetting questions for investors at the moment with things that should have been or have been really solid in people's minds in the past, like even inflation. You know, anchored inflation has always been, or at least in the last few decades, something that investors could count on.
And on the other side of that, you've got the labour market and skepticism around how that's going to play out and the tension that central banks have to deal with between the labour market objectives and the inflation objectives. With valuations where they are in asset prices, it feels like a pretty precarious situation.
It's a lot to think about.
Yeah.
You know, markets are moving faster than ever. There's just so much news flow and markets are reacting really quick. We're getting really big vol spikes, but equally the vol spikes are disappearing just as quickly.
Yeah. So investors want to build resilience to their portfolio. You have this divergence between some asset prices are in full bull market and other asset prices are just languishing along. You know, we're seeing investors, of course, who are looking at other areas of how to build that resilience, build that diversification, things like commodities, for example. Inflation as an asset class is useful there. And we've seen the performance from, within that commodity sector. Gold has just gone through the roof.
Yeah, look, Australian investors are really embracing derivatives in the last few years. You know, obviously we've seen that in terms of the types of instruments, the types of structures people are wanting to deploy. It's definitely a growing area.
What do you think's behind that?
I think there's a number of things behind that. Obviously, we've got a lot of exposures to illiquid assets that Australian investors hold. And so there's definitely an increased demand for liquid assets and liquidity in people's portfolios.
Yep.
But just before, we were talking about the increased volatility and high frequency moves in markets. People are wanting to be more nimble, and derivatives offer that nimbleness for investors that physical allocations just can't.
Your future, your super just brings this other element into this, the performance test there, the sensitivity around the performance test, that awareness of tracking error, even more so than the benchmarking against peers. And that's where just another use of derivatives, portfolio completion strategies. It's from a whole of fund perspective, you just look at where your risks are in terms of tracking error, and you just use derivatives to bridge that gap. We're seeing a big uplift in usage there as well. And then we've got considerations around the use of options in portfolios as well.
Yeah, and there's lots of different scenarios that investors need to think about, right? Like, I mean, you've got asset markets that look a little bit frothy, perhaps valuation basis. You can easily think of events that you know of that you want to protect against. But then there's the other scenario where we just get this slow grind lower as well. So investors are really having to think about how they use options in different ways, right?
And there's a lot of noise around valuations. There's a lot of noise around bubbles. You can use options to sleep better at night, but there's another use here, which is you can use options as your defense that allows you to participate even harder in the bull market. Because in these sorts of bull markets, it's probably that last 10 or 20% that's just so important to capture.
And there's a big risk that if you decide to step back out, that you're going to underperform your peers. So options really provide you a lot of flexibility. I think investors here are just faced with fatter tails than they've ever had. And I think, we're talking about really big changes in global anchors around inflation, around government debt, around trading blocks. And these are things that are going to be really hard to know where we're going quickly. So when we find out the answers to some of these questions, markets could move very violently in either direction. And so, You know, derivatives really do play a really important role here.
Oh yeah, absolutely. Whether you're just looking for some defense, whether you're looking for some uncorrelated return stream, whether you're looking to just bridge that tracking error gap between your portfolio and the benchmarks and your peers, they're the sorts of areas where we're seeing increased use by our clients.
Yeah, I think that's right. There's just multiple purposes.
Yep.
And they all serve very different roles. So there isn't one size fits all, use for derivatives. There's so many benefits, whether it's liquidity, downside risk management, reducing tracking error, protecting against, large market moves in either direction.
Yep.
It goes on and on in terms of what they're able to be used for.
I think we agree.